Hello and welcome everybody. Welcome back to Sectors Made Simple. Happy Friday. Welcome to December and welcome to another Sectors Made Simple webinar. I think I already said that, but so nice I'll say it twice. It's great to have you all here with us today, and today is going to be a market review. This has kind of become a little bit of a tradition at the first webinar of the month, if the month is kind of wonky like the past 2 months have been. We like to do a little bit of a what to expect in the upcoming month. And part of that is not just reviewing or not just looking forward at what might come in the month, but understanding what happened in the previous month. Just like any weather forecast, if you're going to try and predict what is happening in the future, you need to know what's happening today. So, in this webinar, what we're going to do is we're going to take a look at where the market stands, and not just the market, the economy. Where the economy and the market stand as of today, which is December 2nd, and what we can expect or what we should keep our eyes on in December coming forward. This is an incredibly important month, and because of that, I've really tried to take today's webinar and not just look at a month-over-month look at prices, but instead try and look at the big drivers for these price changes. Notably, as I already hinted at before, the economy. The market has very much been shaped by the ins, outs, ups, and downs of the economy and economic data that we are receiving. So if we're talking about the market, if we're talking about forecasting the market and the current state of the market, we also need to cover that as well. So hope you're on board, because today we're going to be covering lots about how November performed in the market, what changed in the economy, where the economy sits today, as well as what we should keep our eyes on moving forward to December. So let's get straight into the action, shall we? Quick disclaimer, today I will be talking about my opinion and my view and analysis of the current state of the economy, the market, and where I think things are moving from here. Whenever I'm sharing my opinion, please remember it is that, my opinion. As much as is possible, I will provide data to back up what I'm saying. I'll provide you sources for where I received that data, and I want you to be able to do your own research as well. Part of what I like to share here is not just the results, but is the thought process. What information did I use to make a decision? How can you get that information so you can make that decision for yourself as well? Please take my opinion as my opinion, not as financial advice. I encourage you and almost implore you, make your own decision, come to your own conclusions, because the best person to help teach you is yourself. So today I want to give you the power to do that. Let's talk about the goals for the webinar today. Another month has come and gone. November is over, Turkey Day is over, and we're moving now into the holiday season. There will be no Christmas music playing in this webinar, unfortunately, or fortunately, depending on who you are. But as we close out the year, we need to look at the market. And right now, the market is in an uncertain state. And I put quotes there for very good reason, and I'll explain why later on in this webinar. But I want to explain that uncertainty in a lot of detail, because it not only affected November's market, but it is affecting today's market, and it will affect December's market as well. So we'll cover this uncertainty, look at the data behind where that word uncertain in quotes comes from, and to do this, we'll look at important dates, things in December that will shape the market. Days that have a higher or lower probability of being positive or negative days in the market. And we are Sectors Made Simple. We do a lot of stuff about relative strength. We will bring lots of relative strength data and check out some Sectors Made Simple tools and their data in this webinar. So let's get started by reviewing November. Again, any good forecast starts with understanding where we are today and how we got here. November has historically been a very, very strong month for the market. If we look at the past 5 and 10 years, there's the chart, we find that the majority of sectors have performed extremely well in this month. We find that communications and utilities had the lowest returns at 0.2% average, positive gain, by the way, in November. Looking towards the top of that chart, though, we find other sectors such as energy, materials, healthcare, financials, all performing well above 3% average return in the month of November, averaged over the last 5 years. That is substantial. That is a period of incredible growth, is another data point to back up the fact that October through February is a period of expected growth and positivity for a vast number of sectors in the market. So, where did 2022 fall? How did we do? Well, spoiler alert, we didn't see 5% returns in energy. Instead, we saw more than 5% returns in almost every single sector. Sorry, energy. Energy was a sector that very much stagnated in November. This was not for any bad news, but rather for the lack of good news. Energy has very much been a strong sector because of the rapid rise of energy costs and how inflation has affected energy. As inflation begins to top out, I'm not going to spoil too much, but if we were to see inflation starting to dip, that means profits are going to decline for energy companies. Again, energy and food are two of the highest inflation rate industries and commodities right now. So this right here is not so much energy did poorly as it is the reasons energy was doing so well have started to dwindle, have started to fall off. In exchange, we see every other sector, discretionary, not so much, different reasons there though. Tesla. Every other sector is performing extremely well, with healthcare being the lowest return at 4.66%, and everything else seeing returns well above that, with materials seeing the largest increase at 11.4%. This was not a smooth ride. In fact, the market started off pretty poorly. We had the beginning of November FOMC meeting that was less than optimistic. But one day, this entire month, well, 2 days, but one day that we can talk about as a it's already happened kind of thing, changed everything. November 10th. Leading up to November 10th, we saw SPY drop about 2% the day before November 10th, so November 9th. We saw SPY drop 2% as the result of a surprising midterm election cycle. Remember, the market doesn't care as much about the donkeys or the elephants. They care about the bulls and the bears. And the one thing that no one really likes is surprises. Midterms were a surprise. So the market, again, they're not going to play one side or the other. They're in it for anything. So we did see a slight drop that day, but November 10th saw a complete reversal, and not because of politics, because of economic data. Economic data was and still is and will be a key driver in the stock market over the next few months. And one piece of information in specific was released on November 10th that really got things fired up for the market. Any guesses of what it is? If you guessed inflation, you would be right. On November 10th, inflation changed everything. That is the exact same slide that somehow got duplicated. Did it? It did get duplicated. Sorry. Inflation day. On November 10th, we received the CPI inflation data for October of 2022. We received this announcement prior to market open on Thursday, November 10th, And those numbers showed a 0.5% decrease in headline CPI inflation. Headline CPI is the inflation that you'll probably see in the headlines of news articles, hence the name. That is going to be inflation for everything that a urban consumer will be buying. Now, there is a different inflation number called core CPI inflation. This core CPI inflation removes things that are a little bit more cyclical, or rather, I'll say seasonal, and a little bit more volatile, such as food and energy, bringing that number from what was 8.2 to 6.6%. The new numbers, instead of seeing a 0.5% drop, we now saw a 0.3% drop in core CPI inflation. That is substantial. Not because the number is big, but because it's the first time, well, rather the second time in the past 18 months that we've seen a drop in both headline and core CPI inflation. There have been points over the past few months that we've seen one or the other drop. Never both. So this is valuable. This is important. And this is a sign that we're kind of starting to move in the right direction. The other time that this happened was March of 2022, where we saw a single month that both of these dropped, after which headline CPI inflation, once again, thank you energy costs, continued its upward trend. Core CPI was soon to follow. Needless to say, the market responded very positively to the idea that the worst of inflation might be behind us. SPY surged almost 4% before the market even opened and ended the day 5.5% up, making it one of the largest price increases since 2009. Now, excluding 2020, of course. But for 1 week performance, things got even more substantial. If we looked at sector ETFs, we found more sensitive sectors such as communications and technology, gaining 8.2 and 9.9% on the week, respectively. Now, we didn't continue rising from there. In fact, we kind of just stayed still. There were days of positive changes, negative changes, all within the range of plus or minus 2%. But all things considered, after we came out of that week, we were less than 1% changed. Now, Thanksgiving, we talked a little bit about it in last month's forecast. We said how Thanksgiving, the 2 days before and the 2 days after, are meant to be a great period for the market. We should expect to see gains. The probabilities of gains are very, very high. Black Friday, all of this. Let's see if that happened in 2022. To do that, we're going to go and take a look at this spreadsheet. On this spreadsheet, what we will find is the probability of changes for the S&P 500 over the past 66 years and 20 years. Let me see if I can make this bigger. A little bit too big. How about that? Then, to the right of all of the changes, or the probabilities rather, we see the actual price changes for the S&P 500 ETF SPY. In each case, what we will look at is we'll see, is this change expected? Now, that doesn't mean, was it profitable? That means if we expected it, or if the probability had a higher chance of being positive, and it was positive, that'd be expected. If it was below 50%, which is more likely to be a negative day, and it was negative, that's also expected. A surprise occurs when what we thought was going to happen and what did happen were different things. In this case, what we find is things leading up to Thanksgiving were pretty expected. Leading out of Thanksgiving were surprises. So where we went from there was not so much what we expected. In fact, the 2 days after Thanksgiving, the 3 days after Thanksgiving were all negative. When the 25th was supposed to be an excellent day. Over the past 20 years, 16 of those years were positive. Well, now it's 16 out of the last 21, because this year was technically negative at a loss of 0.2%, or 0.02%. There we go. So was the Thanksgiving holiday season a boom for the market? Not so much. Because was it good? No. But it wasn't terrible either. Looking at that chart a little bit more closely, we did see gains leading up to Thanksgiving, losses after Thanksgiving. Pretend the 30th doesn't exist. We'll just pretend that doesn't exist. I'll talk about that in a minute. But leading up to Thanksgiving, or coming out of Thanksgiving, we saw 3 consecutive days of losses. Albeit 2 of the days were small losses nonetheless. So in the 2 days prior to through the end of Thanksgiving, we saw a 0.2% gain throughout that period. Looking closer at that week, sadly the chart doesn't show that, but what we would find is that 7 out of the 11 sectors, the GICS sectors, were positive, but were dragged down because of the other 4 sectors, 3 of which performed quite poorly, being discretionary, technology, and communications. Whenever we talk about sensitive or defensive sectors, what we mean by this is that there are sectors, it's not that they are inverse. It's not that when the market does poorly, defensive sectors do well. Or when the market does well, defensive sectors do poorly. What we mean by that is it's kind of like a rubber band. A sensitive sector, you can pull it a lot further, and when you let it go, it's going to snap. That is a sensitive sector. It can change a lot more and will change a lot more and move with the market, but see bigger changes on average than the S&P 500. Defensive sectors are a little bit less like a rubber band and a little bit more like a stress ball. You can squish it, it might come back a little bit, but it's not going to be fast, it's not going to be sharp, it's just going to come back a little bit. This is our defensive sectors. They are the sectors that, again, are not going to move opposite the market, but are going to be a little bit more stable. In periods where the market is going down, they will see smaller losses, but on average, we'll also see smaller gains when the market is doing extremely well. These 3 sectors, discretionary, technology, and communications, were 3 very defensive sectors. Sorry, 3 very sensitive sectors, my apologies. In contrast, I want to quickly go and a little bit of sequence break here. I want to go and look at the Sectors Made Simple matrix. And I want to take a look at what the matrix was back on the Friday after Thanksgiving, which was the 25th. We can quickly wait for this to load. Come down here, custom momentum. We want 1125. Go. This will allow us to see what sectors were leaders at that point. What we end up seeing, technology, discretionary, communications, we're all sharing the spots for last place. Last, second to last, third to last. If we look 1 week earlier, we should see, they were a little bit higher up. There's technology, there's discretionary, there's communications. So what we are finding is that these sectors really did not perform well, and in the case of technology, lost a significant amount of strength over that week. But that's up through the 29th of November. Everything changed once again on November 30th. To say November was a month defined by the FOMC is an understatement. November was bookended. It started and ended with speeches by Federal Reserve Chairman Jerome Powell. Not by design, just kind of the way it is. At the beginning of the month, we had the FOMC's meeting, which tanked the market almost 4%. If we look here, what we end up finding is that right here, these were the days surrounding the FOMC meeting back in December. Now, that's the 4% loss. And the reasoning for that is that in the meeting, or rather, we don't get to be in the meeting, but at the end of the meeting, Jerome Powell comes out and holds a press conference. And in that conference, he reaffirmed the Fed's aggressive stance and position to make changes to the federal funds rate and other financial instruments to help combat inflation. Again, we saw a slight decrease in headline inflation and an increase in core inflation back in September. For September's numbers that we got in October. What that's telling us is that, or what that was telling the Fed rather, is that what they were doing wasn't enough. They needed to do more. So between November 2nd and November 30th, that inflation data came out. How did that inflation data actually impact Powell's speech? Because on November 30th, while it wasn't a speech given as the result of the FOMC, Powell did have a speech as part of, I believe it was a conference. Regardless, he did have a speech where he talked about the current state and outlook on the US economy, and in that speech, his tone shifted completely. Not completely, but in a very large way. He did note that the Fed is seeing a decrease in inflation. And that decrease is, again, just as it was for the market, for him, a very positive indicator that the aggressive changes that they've made are seeing results. But the Fed still plans, they're not letting up right now. They reaffirmed a commitment to continuing to push the federal funds rate until this inflation actually gets back under control. The best indications we have of where the Fed thinks things are going and where they think they are right now is the summary of economic projections. Every quarter, we get a summary of economic projections from the FOMC, and the most recent issue that we got was from September. September's summary of economic projections had an average expectation of the federal funds rate at the end of 2022 at 4.4%. Currently, the rate is sitting between 3.75 and 4%. The past two increases to the federal funds rate have been 0.75%. I threw out a whole bunch of numbers there, but let's just get away from the numbers, get back to what we should actually care about with those numbers. The Fed has made some really big changes, extremely large changes, in 0.75 increases. We should expect them to, in their next meeting, increase the federal funds rate again. That increase is more likely to be, my opinion here, more likely to be 0.5% instead of 0.75%. It is still going to be above their estimate from September, but again, they are slowing down because their goal in tackling inflation has started to actually see some results. Beyond inflation, everyone always thinks recession. Are we in a recession? Are we entering a recession? You might ask, what is a recession? To bring it all together, A recession is a market downturn or an economic downturn that is the result of decreased growth, high inflation, or rather inflation that needs to come back down a little bit, and really a period that is not something that investors nor consumers really look forward to. It's where you start watching how much you're spending a little bit more. It's where job layoffs might begin. But if people, again, there's not a one person that says we're now in a recession, we're not in a recession. There are a number of different factors, and one of the most common that people look at is GDP. How much stuff does the US make? If we see GDP decreasing for 2 consecutive quarters, that is the textbook definition of a recession. We have not seen that. Rather, GDP growth right now is growing. And in fact, the Fed provided their estimates, not a number, but a qualitative estimate of where they think Q4 GDP is going to be. They expect it to be positive. They expect GDP growth. And they expect that the GDP for the year of 2022 will be an increase, not a decrease. That right there is, again, you can't just say inflation, or rather GDP equals recession, not recession. There's so many more factors to it. I'll get to that later. But for Jerome Powell to come out and say GDP is rising is a very strong indicator, not only for the economy, but also for the market. The market plays in the economy. So seeing a GDP increase is a very positive indicator for the economy and for the stock market. Jonathan, what about the interest rates went down in the speech, or what to expect? Interest rates are likely going to continue to go up. Again, we are currently sitting at 3.75 to 4% for the federal funds rate, and the the average of the summary of economic projections from September the median, so the middle value, was 4.4%. The central tendency, which is the big chunk of the middle people, 4.1 to 4.4%. The lowest estimate was 3.9. The highest estimate was 4.6. That is where the Federal Reserve members and the chairs of all of the different branches believe that the federal funds rate will be at the end of 2022. For our purposes here, let's take the 4.1 to 4.4 number. There is one more meeting left in the month, or left in the year. And if we're going to go off of 4.1 to 4.4, and Jerome Powell in his speech said that we should expect that the FOMC underestimated where the actual federal funds rate number will be, I expect 4.5. That is going to fall very closely in line with what he was saying. Again, speeches are very much qualitative. They are words to explain information, not quantitative, which is numbers. He did show lots of cool charts. If you're a person that thinks economic data is interesting, you're crazy, so am I. It's a great speech. Go watch it. There's lots of cool information. If you don't care about that and you just want to hear the explanation of it, from what he's saying, things are going to slow down, so I don't expect another 0.75% increase. But he did say estimates from the summary are a little lower than what the reality will be. My guess, 4.5% is what we should see. When is the end of Q4? When would the earnings of Q4 be announced? End of Q4 is the end of the year, so the end of December 2022. Earnings typically will be in the range of 4 to 8 weeks after the release. So if you're curious, the website I always like to use for earnings is Zacks. I like using Zacks earnings estimate calendar. there is a link. But yeah, we should expect earnings for quarter four to come a little bit later, because those are not just quarterly reports, those are annual reports. So if you're interested to learn more about that, I actually do have a really detailed webinar all about earnings reports, and I'd recommend going to check that out. I explain in a lot more detail the differences between quarterly and annual reports, as well as the deadlines in which companies have to file their reports with the SEC. Anyway, let's get back to Jerome Powell, his speech this past week, and what that meant for the market. It meant some good things. The market was stoked, super happy about Jerome Powell's speech and the great change in tone. Again, optimism is not the right word here, but productivity or productiveness was. Things are moving in the right direction. And as a result, SPY jumped 3.15% on the day, with only one sector seeing losses. Go figure, energy. And the big winners on the day, once again, go figure, are those sensitive sectors that have seen the biggest bigs and the lowest lows as a result of the market shifts. Technology, communications, discretionary. I'm just going to lump those together and say the cyclical sectors or the offensive sectors, because we're going to talk about them a lot today. Now, we can talk about all these little changes or price changes on the daily or weekly level all we want. But there's something else that I haven't talked about in a monthly forecast before, and I want to in this case. Volatility. Because volatility is another area that we are actually seeing quite a bit of progress. If you're not familiar with the VIX, want a refresher, or whatnot, somewhere in the middle. Quick review on the VIX. The VIX is a fear gauge of the S&P 500. It's a way of us knowing what the uncertainty in the S&P 500 is expected to be. Remember how before I used the word uncertainty but put it in quotes? The VIX is the reason why. Because right now, or rather, when the VIX is higher than what it's supposed to be, my apologies. VIX is represented as a number. The higher that number is, the more volatile or uncertain the market is expected to be. A normal, stable market is a VIX of 15. Anything above 20 is considered to be a more uncertain market. As of December 2nd, when this presentation is being given, the VIX currently sits at 19.06. That is 25% lower than its value on the 1st of November, so 1 month change at 25%. And it's the lowest it's been since April of 2022. This is the reason why that word uncertain before had quotes. The market is technically more certain right now. The VIX is the lowest it's been in 7 months. But the overall direction of the market, I think, is still uncertain, which is why I used that word in the first place. And all of that brings us to today, December 2nd of 2022. So before we talk about the market forecast for December, I want to look a little bit more broadly at the state of the US economy. We just talked about how some of the worst days and the best days in November were because of economic data releases and economic announcements. CPI, FOMC, and Jerome Powell. Why? My opinion, right now the market is being shaped by economic data. The uncertainty in the market is arising from people not knowing about what direction the market and the economy are headed. That relates to many things. Jobs, spending, confidence, GDP, inflation. There's a number of different factors that go into this economic data circle. So if we're going to talk about where the market is headed from here, the market over the past month has been defined by the economy and economic data. I don't see that changing in December. That is why I say that the market is slightly uncertain. It's not that the VIX is elevated. It's not that market volatility is high. It's that right now, the market is made or broken by economic data and announcements by economic figures. So while we can and we will look at historical averages and probabilities, what's going to be more important for us is to look at where we sit as an economy and financially moving into December of 2022. Again, we will very much now get into my opinion. So where and really everywhere possible, I will give you the sources of the data. I will show you the data and encourage you to make your own decisions and conclusions about what that data shows as well. Before we get super far into the economic data, let's ask the big question, are we in a bull market? November was really, really good. Was it so good that we can now say we're in a bull market? No. But we're getting closer. The technical definition, again, textbooks never are identical to real life. But the technical textbook definition of a bull market is when we leave a bear market, which is to say we rise, the index, in this case the S&P 500, rises 20% above its lowest point. Currently, in this bear market, actually not quotes, bear market, the low for SPY is 348.11. And the current price, as of December 2nd, market close, is 406.91. That is a percent change of 16.9%. That is getting close to a bull market. But not there yet. We're not there yet. Another thing you can look at, if you want to know, are we in a bull market or are we in a bear market, is BPI. BPI, the bullish percent index, hopefully has something to do with the bull. It is a percent between 0 and 100 to show what percent of companies in a given sector are on a buy signal. Point and figure and BPI standards say anything 50% or higher is considered to be a bullish market. On Sectors Made Simple, let me start here. On stock charts, they offer S&P 500 bullish percent indices for every sector. We wanted to expand that a little bit, so we instead looked at the entire New York Stock Exchange. So what you're looking at now is Sectors Made Simple's data on the bullish percent index for all of the different sectors within the New York Stock Exchange. If we sort by BPI, we find over half of sectors are currently in a bullish zone, above 50%. The remaining 4 are getting pretty darn close, and these X's indicate that they're currently rising. Are we in a bull market right now? No. Are we close to one? Yeah. Both BPI and S&P 500's price indicate that. But there's more than just this that we can use. Bull markets, bear markets, and everything in between is part of something known as sector rotation. Sector rotation is something that is and has been at the center of what we do here at Sectors Made Simple. Much of our knowledge of relative strength and the strategies that we share rely on the fact that sector rotation is a thing. As we move through bull markets and bear markets, which is connected to recessions and growth, there are different sectors that we should see being the leaders during any of these periods. So, Instead of us saying we're in a recession, what sector should be the leader, or we are exiting a recession, what sector should be the leader? Okay, sorry, not recession. We are exiting a bear market, what sectors should be the leaders? We can use sector rotation for that. So what does sector rotation have to say? Quick review. This is what sector rotation looks like. It is a connection between sectors, the market, and the economy. The blue line down below is the economy. There's periods of recovery and recession, growth and pullback. Then there is the market in orange. Bull markets, bear markets, and every little color in between. What you see up at the top are the sectors that are expected to be the leaders or the strongest performing sectors during all of these different phases of this cycle. So we can use this. If we know what sectors are currently gaining the most strength or are our leaders at the moment, we can understand where in the cycle we are. Is it full recovery, bear market? Are we exiting the bear market and going into market bottom? Where are we? Again, to do this, we can use Sectors Made Simple data. We can quickly and in quite literally seconds see not only who the leading sectors are, but also which sectors are gaining the most strength. And we can do this in both short-term and long-term strength. So let's go and take a look at that data. So coming back to the matrix here, we see relative strength as it exists right now. All of these are spider ETFs representing each sector. And we can sort here by X count, which is short-term strength, positive trend, which is long-term strength. And we can see what sectors are leading right now with the highest total counts. The first thing I want us to look at is not who the leaders are today, it's who has gained the most ground over the past week. We've just talked about there's been some crazy price changes in this past week, and that has resulted in some ridiculously large changes in relative strength. Here we see 3 sectors gaining significant strength. XLY discretionary, XLK technology, XLC communications. Those 3 sensitive sectors that we've talked about before. If we sort here by total strength, we find technology. Technology is our leader. Communications and discretionary are still down here. But this is where it's really great to have short-term and long-term strength. Because if we sort by total count, XLY and XLC, discretionary and communications, are pretty low on the matrix. The minute we sort by short-term strength in X count, we find communications further up, as well as discretionary on its way up as well. And note this, most of these other sectors are pretty close in terms of short-term and long-term strength, within 2 to 4. Technology is a difference of 6. Communications is a difference of 7. Discretionary is a difference of 4. All trending towards that short-term growth. So what does that actually tell us? It tells us that these 3 sensitive sectors are gaining the most strength in the short term. And technology has become our overall leader as well. But not only that, we also saw that there is a pretty large difference between the short-term strength and long-term strength of these 3 sectors, which means they have a lot of short-term strength, but we need a little bit more to be able to call them real sector leaders. short-term strength is easier to change than long-term strength, of course. Short-term, easier, long-term. So we need that long-term to be the confirmation before we can really say these are our new sector leaders. And if those sectors emerge as sector leaders, technology, discretionary communication services puts us smack in the middle of a market bottom, moving towards a bull market. The other two sectors here, industrials and materials, we find those, materials being the overall sector leader, industrials somewhere in the middle. So again, the matrix is showing that the sectors that are gaining the most strength right now, short term, are these sectors to indicate that we are exiting a bear market and moving through a recession. But it's too early to say that for certain. We need that long-term strength to give us confirmation. So let's look at another piece of data and see if we can get anything else out of this. In addition to the matrix, which looks at sector ETFs, we also do a matrix of the entire S&P 500, which allows us to compare 500 companies every single day to see leaders. We then use that information to find how many companies in each sector are performing well or poorly compared to each other. So if we sort here by the overall strongest sectors, we find technology has the highest overall strength for both short-term and overall strength. Cyclical is here in third place for both short and total strength, and in fact is in first place for long-term strength. And communication services is somewhere in the middle, representing sixth place, so just in the middle of the entire matrix, meaning that we need to see it move just a little bit more. And that makes sense. We should be seeing technology as the strongest, discretionary as the second strongest, communication services as the third strongest. Technology, discretionary, communication. All right, that says that. Technology, discretionary, communications. Okay. Relative strength data is confirming this. And the one thing that this is also confirming is that it's way too early to draw any conclusions. That long-term strength is very low compared to the short-term strength. Let me just go back in time like 1 month. This, by the way, this part, not part of me preparing or anything, I'm just clicking some random things. This is a little bit more what we should be seeing. Long-term and short-term strength somewhere in the same ballpark. Anytime you see a big difference between short-term and long-term strength, there's a lot of change going on. And we don't know where it's come out yet. That is what we're seeing right here. Every single sector, except staples, has a large difference between its short-term and its long-term strength, meaning things are changing in the short term. It's too early to say if those changes are here to stay. So the S&P screener and the matrix are showing the same thing. Technology, discretionary, and communications are performing extremely well in the short term, indicating that we are moving into that mid-recession, early bull market period. But again, we need that long-term strength as a confirmation. It is still too early to tell. So now, let's look back at economic data to see what the economic data says. We've used the matrix to figure out where in this chart we think we are. And we think we're somewhere around right here. The trend is starting to go back up for the market. The economy is starting to get towards its bottom. Does the economic data support everything that I was just saying? Not really, or rather not entirely. Because honestly, the economic data is absolutely all over the place. It is insanely confused. Let me show you. GDP, that gross domestic production value that we talked about before, we should expect GDP in a full recession, bull market, to be bottoming, flat. That's where we are. In an early recession, bear market, we would see GDP declining. We don't see that. We see GDP growing right now. Bond yields. Bond yields are a way of trying to express where we feel the strength is, short-term or long-term. We do this by comparing the yield or the interest rates for 10-year bonds versus 2-year bonds. And if that chart goes negative, it's what's called an inverted yield curve. That is something that we would see in an early recession or bear market, and has historically only happened prior to a recession. Looking back, these gray areas indicate recessions. Every time the yield curve has gone negative, a recession has followed. Looking right now, the yield curve is very negative. If that is something for us to go off of, it's saying we are still in an early recession. How about consumers? What do consumers feel? Well, funny enough, it depends on the data you look at. If you ask the University of Michigan and their consumer survey, they would say that consumer sentiment is improving. It's rising. If you looked instead at the release from, I believe it's called Commerce Data, their consumer data, and this is the one that the Federal Reserve publishes, they indicate that consumer confidence is decreasing and that we're worried about the short-term outlook of jobs and spending. So that's somewhere between early recession and full recession. So again, GDP says we're coming out of a recession. Or rather, we're coming into a bull market. I'll stick to terms of the market here. Bond yields say we're still in the bear market. We're not there yet. Consumer expectations, somewhere between the two. And investor sentiment is currently decreasing over the past 2 weeks, which once again is expected in an early recession bear market. Sector rotation tells us that we are here. Technology, discretionary communication services. GDP says the same thing. The University of Michigan's consumer data says the same thing. The bond yield curve, the corporate bond distress index, which I didn't show today, but is another valuable economic indicator, the consumer sentiment and investor sentiment all put us somewhere over here in the early recession bear market period. Now you see why I still used the word uncertain despite a low over the past 6 months for market volatility. There's only one thing that is certain right now, that nothing is certain. Market data and economic data both indicate that we're entering a bull market or that we're still moving through a late bear market, but it's far too early to tell. There's a reason why in this entire forecast I've focused so much on economic data, because over the past 2 months, the market has been defined by it. We have been heavily dependent on the results of the FOMC and other economic organizations, such as the Bureau of Labor Statistics, releasing economic data for us. So before we get into the monthly and daily probabilities, and I'm literally going to glance over those, just show them to you if you're interested. Otherwise, they're not as important as what I've been talking about, the economic side of all of this. So let's look at some dates for economic data releases in December and 2 market events that I also want us to keep an eye on. First, the economic data. December 8th, we will receive unemployment and jobless data for November of 2022. December 13th, we'll see the release of the November 2022 Consumer Price Index inflation data. That was that November 10th announcement that sent the market skyrocketing. Will it do the same this month? Or if we see a slight increase or not as big of a decrease as we were hoping for, will the market respond negatively as a result? On the same day and the day after, just adding to a double whammy, we get the FOMC meeting and the summary of economic projections for their year-end 2022 report. Those are the three big economic events to keep an eye on. There's also two market events. One market event and then one just event. December 16th, holy cow, that is an eventful week, is Triple Witching Week. It will see the expiration of options and futures and will be a day of increased volatility and increased trade volume for the market. And then Christmas. Seems silly to say, but Christmas is in fact a market event because market volume slows. People start going on vacation. Portfolios are pretty much settled for the end of year. Trading volume goes down around Christmas, and also Christmas has a couple of really positive days for the market. So let's go and quickly take a look here at the major index probabilities for December. The NASDAQ over the past 20 years has performed pretty well over the upcoming week. Pretty average results across the board for the others. The FOMC meeting week very much puts the focus on large cap companies as the Russell 2000 has one of its worst weeks of the month. The week after, the story flips. Most major indices have some pretty bad days coming out of Triple Witching Friday, while the Russell has one of its strongest weeks overall. And the 27th, the next trading day after Christmas, the market's still in the holiday mood, and we have an almost 2/3, if not 3/4 chance of seeing positive returns. So, what does that tell us? Well, December has been a bumpy month over the past 66 years, but it has recovered pretty nicely over the past 20. For everyone that's not the Russell 2000, the two worst days of the month are going to be right after Triple Witching Friday. While that same week, the Triple Witching week is the worst for the Russell. The week after is the best. And the 27th is a day that we all love because the market should do pretty well. Now let's quickly take a look at sector averages. Not too much to say here. I'm going to skim through this pretty quick. Every sector has a probability over 50% of going up this month, but the returns are muted compared to November. Most are in the range of -1% to 1%, with only a few exceeding that. Let's now bring things together and talk about the takeaways and my opinion. While volatility is down and uncertainty is down, uncertainty is still there. In my opinion, that is what is going to shape the market in December. We don't know if this economic data is going to, we hope that this economic data is going to be a boon and show that things continue to move in the right direction. There's been little to say that they are not. So this data is very much going to be what shapes the market this month. And for my personal opinion, it's still too early to say we are in a bull market. Just as it's still, funny enough, too early to say we're entering a recession. The data is inconclusive. Sector rotation is saying one thing. Even economic data is saying different things depending on who you ask. The best thing we can do is understand this. We trade in the stock market, but we invest in the economy. Silly to say, but let me break that down. The day-to-day investing that you do is in the stock market. You trade on a day-to-day basis and you monitor what's changing and the price changes on a day-to-day basis. there is still lots of room for profit in both good markets, bad markets, and volatile markets. But now is also the time that keeping an eye on the market is very important. Because as far as mid and long-term investments are concerned, you're investing in the state of the economy and the direction of the economy. And while that is historically and always will be an overall gain, it could be a bumpy road to get to that. And we still don't know where in the cycle we really are. Recession, bull market, somewhere in the middle. The last thing I'm going to say, remember that a recession is not a horrible, horrible thing as far as the stock market is concerned. It is not an ideal thing, but market pullback is necessary for long-term economic growth. It's a way of fixing the imbalances in the economy. It is not fun to go through, but it is very much necessary and a necessary part of our economy moving forward. And bull markets begin in bear markets. If we look back at the sector rotation chart, a bull market begins before recovery begins. The market cycle precedes the economic cycle. So, if sector rotation is what you want to focus on, and you want to focus on the market, we're somewhere in this range right now. But again, we want that long-term data to show that. The things to keep an eye on for that long-term data are going to be things like the sector averages positive trend, BPI, and positive trend on the matrix as well. Those more long-term indicators are going to be what are going to provide us confirmation or concern if these trends are here to stay, and expect that economic data to be large days of change, positive or negative for the market, depending on which side of things they fall. Romulo is asking, so after all, which strategy would you recommend to apply? That is a very tough question. The matrix strategy that we always talk about and share is meant to be a more passive long-term strategy. It is something that has outperformed the S&P 500 consistently. But it is also something that there's no such thing as free money. The free money is gone. That was 2020. Now, the thing is, you got to really work for it. There's a lot of room for opportunity, such as options, such as short-term investing and buying a stock for a couple of days or selling it after that, and buying based on relative strength. Those are all still valid methods. What I will caution you against is following a trend and just saying, oh, well, it used to work, so it should still work. Always be looking for things to improve. Always look at how you can improve your strategies. That's why when I share a matrix strategy, I say this should be a starting point, not your end goal. Sure, you can start with that, but the best strategy is one that you can take, learn from, and make changes to make it work the best for you. If you're the kind of investor that wants to sit there and watch your investments all day, every day, there's a lot of room for profit to be made. And in the La Mosca en la Pared series, Melly and my mom have shown that. They have shown double-digit profits through trading options in a couple of hours. If you're the person that wants to be a little bit more hands-off, now is a tough time for that. Because we kind of know what might happen in the next day or two, but surrounding those economic data releases, jury's out. It can go either way, and it doesn't mean if inflation go down, market go up. The market is going to bet on where they think the line is. If you go and play sports betting, you don't bet on which team's going to win. You bet on how much you think they're going to win by. The line might say, we take the Steelers by 7.5. So you're not betting, will the Steelers win? You're betting, will they win by more than 7.5 points? The market's going to do that too. They're going to say, we expect the federal funds rate to go up by 0.5%, like my guess was. If it's more than that, the market is going to respond negatively. If it's less than that, the market's going to respond positively. So it's a crazy market to be investing in, but this is also the kind of market where savvy investors can make a lot of money, and anyone that is very passionate about data is going to have a lot to talk about and a lot to review. There is lots of data for us to go over, and I will do my best to be here with you all and share that data as it comes out and what that means for the market and how it's affecting the market. This is very much an ongoing process. There's not a lot of history to show what happens in periods like this. Every bear market is different. Every recession is different. And the best thing we can do is understand what's happening today so we can try and understand what might happen tomorrow. On that note, if you want to talk more about stuff like this, if you haven't noticed, I really enjoy it. It's awesome to be able to look over data and share it with you all, and more importantly, bring it down to a level of why we should care. It's overwhelming to have all of this stuff going on and for none of it to agree. But that's kind of where a lot of the value can come from, of keeping your eyes on things, having resources like Sectors Made Simple. I swear I'm not trying to plug it this much, but really it is a valuable tool for tracking sector rotation. Data is king. That's why we made Sectors Made Simple. That's why we do these forecasts, both a review and a forecast. They go hand in hand at trying to help us all invest simpler by understanding the market simpler. So thank you all so much for joining us today. Hope you enjoyed. If you have more questions or just want to talk more about economic stuff or market stuff, send us an email at support@sectorsmadesimple.com. It's not a support team. It's me, my wife, and sometimes my cat. So, from all of us, thank you all so much for joining us today. We'll see you all back next week for another Sectors Made Simple webinar as we find new ways to help you all invest simpler. Thank you all so much. Take care.